Hi, thanks for joining me again. Today we're going to talk for a little while about springs. Almost all of the charting principles we look at have a mirror image opposite. And the mirror image opposite of a Wyckoff style upthrust is a spring. If I just grab this little chart here and flip it upwards, just here is a Wyckoff style upthrust where price moves up, finds resistance, comes back, challenges for a second time, is briefly able to overcome the resistance but is forced back down. That's a Wyckoff style upthrust. And the mirror image opposite of that is the spring. We'll just quickly read through this and look at some examples. A spring is effectively a successful test of previous support. Here is the previous support. You can see price responds to that buying that came off the low. It moves higher. And then when price comes up and reaches resistance, about 50% of the time, price will come back and retest the lows for strength. Now, sometimes this is for accumulation purposes, and other times it's just to see whether there really is good strength in the market. And when a spring is formed, it's always on the retest of a previous low or a previous support level, like this. So that's what we're looking at. A spring is formed when price dips below a previous support level, but fails to continue lower, and instead reverses to close back above the previous support level. Here's the previous support level. You can see just here, price has dipped just lower, just below the previous support level, but has failed to continue going lower and instead has reversed to close higher, and here's the close of the bar. This little dip below the previous support is the spring. That's what's called a spring, that little dip below the previous support. Over here now, in very large liquid markets, such as futures markets, a very shallow and brief spring is considered stronger than a deep and sustained spring. See how down here, this is a much deeper spring. Price was able to push considerably further below the support level before enough strength came in or support came in to recover back above the line. A little shallow and brief spring is considered much stronger on average than a deeper, more sustained spring. This is because the small and brief spring is showing that support is strong in the market and at the previous support level, and that the market is prepared to defend price against supply. So when price dips below the previous support here, quick as a flash, buying and support came in to defend price against this level. The market was not going to allow price to continue lower, and if it did, they were in there buying the market. You can see the defense came in immediately, price just briefly dipped below and then shot back up. And you can see in this case, the response to the spring bar, price continued higher and then a nice little test. Whereas a deep and sustained spring has shown that while price did recover, it also shows that the market was slow to respond to the break below previous support. And if put under repeated pressure, that previous support level could be broken, and then price can actually continue lower. That's the danger. Less liquid markets, however, can see price moved a little more freely and easily. So you need to have a further element of judgment and flexibility when you're considering springs in less liquid markets, especially in small and micro caps, when you may see a dip lower, but it's not necessarily reflecting weakness, it's reflecting a lack of liquidity in the market, and perhaps they were running for stops, and then they push back out and you get a deep spring, but it wasn't actually a weakness. Over here again, springs generally work best and are most powerful and consistent with buying or strength in the background of a chart. Now I've got a video on the background. Just go back into the price and volume playlist and you'll find it. Springs are also most consistent and powerful after a breakout above a trading range or an accumulation zone, or when price is in an uptrend. Springs work worst or are least powerful and consistent with weakness or selling in the background of a chart, following a price breakdown, or when price is in a downtrend. All these would be considered to be in the wrong place. So if you see a spring and price is in a downtrend or with weakness or selling in the background of a chart, it's considered the spring is in the wrong place. And it may work, but it'll be less powerful and probably briefer. I don't suggest you support springs that are in a downtrend or with weakness in the immediate background. Springs are often thought of as appearing at and around the major lows of a chart. However, they regularly occur during an uptrend, particularly during a minor pullback or following a brief period of sideways trading. That would be on the breakout of a little period of sideways trading. Finally, and this is important, springs can and do fail, especially when they're seen in the wrong place. A failed spring can be considered a sign of weakness in itself, just like a breakdown bar, for instance. A failed spring, so you'll see a spring such as this one here, and it actually completes, but then price reverses straight away or almost straight away and continues lower. And while you can say that the spring was successful for 2 bars, it's made almost no ground higher and it's failed almost immediately. Sometimes you'll find that you'll get the spring bar and then immediately price will break down here. In this case here, price did go up with 2 bars. It would be still considered a weak bar, even though it was a successful spring. Let's look at a couple more examples. Over here you can see this is showing price trading in a range here. And then price breaks out above the range. Price comes back and tests for strength. Strength is found to be present. And then there's a secondary test. You can see on this time, prices dipped just below the previous test for strength. So the secondary test is a spring of the test of a breakout. Here's the breakout. Here's the test of the breakout. And this is the spring on the test of a breakout, where price just dips below. And in futures markets in particular, you see this quite a lot, and you can buy it as price pushes past the high of the test, and they can be quite powerful, because what you've got is strength in the background down here. You've got a breakout above a sideways range, a successful test of the breakout, and then a secondary test of the breakout with a spring. This can often be quite a powerful setup, especially in large liquid markets like futures markets. Now here's one at the lows. You can see here price has been downtrending, got some form of climactic action down here, and support comes in. You've got an automatic reaction, which is effectively price trading in a supply vacuum briefly, and perhaps a little bit of short covering. Then price comes back to test the strength of the previous support level, and a little spring is formed where price just dips below the previous support and recovers to push higher in response. You can see in this case, you've got some accumulation going in. This strength that was seen here, price needs to go into the regular mop-up of supply and further accumulation. This is what generally happens during a sideways trading period. And then price breaks out here. Price comes back to test the breakout for strength. It pushes higher. And on the secondary test, you've got, just as you saw before, a spring on the test of a breakout. And then in response, price starts to push away. This is usually a very strong move and one you should look for regularly, especially in large liquid markets. So hopefully you're starting to get an eye for them now. The spring is the dip below previous support where price recovers, preferably quickly. And this is the spring. Now this is also a spring here, but it's quite a deep and sustained spring compared to this spring. This is the type you'd be better off looking for, but sometimes this type is successful as well. You just need to make a judgment call on the market you're trading in. Okay, hopefully that makes sense and you can understand. Springs can be quite a powerful trading indicator. In fact, some successful traders exist completely trading springs and upthrusts in the large futures markets. Both have such a powerful nature to them and are quite consistent when you pick them under the right conditions, that you can survive quite well just trading springs and upthrusts. Okay, that's my lot for today. Thank you. See ya.